right? Not 2 meetings ago, he was like, soft landing, or actually no landing, right? We're not even going to land this plane. We're just going to take off again. We're going to do a touch and go, and life is good. And now, well, we can't have soft landing as our base case. Of course, it's your base case. That's always been your base case. I mean, you're telling us there's maybe a medium landing? Is this the Chuck Yeager definition? Any landing you can walk away from is a good landing. And if you can use the plane tomorrow, it's a great landing. I mean, I don't know. It's confusing.
U.S. Federal Reserve officials warned on Friday of further rate hikes even after voting to hold the benchmark federal funds rate steady at a meeting this week, with 3 policymakers saying they remain uncertain the inflation battle is finished. Their comments were tempered by words like patience and an acknowledgement that price increases have been slowing. But in the first public comments since the central bank this week agreed to hold its benchmark rate steady in a range of from 5.25% to 5.5%, the emphasis was on the possibility that rates may still rise and on the fact that monetary policy will likely remain tight longer than previously expected. Inflation is still too high, and I expect it will likely be appropriate for the Federal Open Market Committee to raise rates further and hold them at a restrictive level for some time to return inflation to our 2% goal in a timely way, Fed Governor Michelle Baumann said in prepared remarks for an Independent Community Bankers of Colorado event. Progress on inflation is likely to be slow given the current level of monetary policy restraint, she said, noting that in policymaker projections issued by the Fed earlier this week, inflation remains above the 2% target at least until the end of 2025. Mark Yusko gives his 2 cents about the Fed meeting and its effect on the market. He also pointed out the increasing Treasury holdings by countries that could potentially be rivals and also deflation, debt, and the bond market. Before getting into this action-packed video, make sure to hit the like button, subscribe, and drop your comments below. Enjoy.
You know, this idea that the market still, after all his protestations to the contrary, actually believes they're going to start cutting rates. Now, not as much, but they're going to start cutting rates in March. I mean, March is not that long from now, right? And so that I just find the whole thing kind of interesting. Is the Fed chair says something, and it's been going on for the past few years, and people are just like, yeah, whatever. I'm going to believe the opposite, and in some ways, there's a directionality that's right. You know, people for 7-8 years said Fed's going to raise rates, and the upward slope of the Fed futures curve was consistently wrong for 7 to 8 years. And then suddenly it was understated because, he cranked up, the knob to 11. And now they're going to be consistently wrong on this downward slope. And I just find the whole game kind of silly. But that said, I think there's a bunch of things that came out of this that are interesting and confusing in a way, right? Not 2 meetings ago, he was like, soft landing, or actually no landing, right? We're not even going to land this plane. We're just going to take off again. We're going to do a touch and go, and life is good. And now, well, we can't have soft landing as our base case. Of course, it's your base case. That's always been your base case. I mean, you're telling us there's maybe a medium landing? Is this the Chuck Yeager definition? Any landing you can walk away from is a good landing. And if you can use the plane tomorrow, it's a great landing. I mean, I don't know. It's confusing. And then the last part is rates. Rates are in free ascent. Forget free fall. They are in free ascent. And that's kind of contrary to this idea that they're going to offload their balance sheet. So what you're telling me is you're going to sell bonds at a loss? I mean, if you acquired all these bonds at low interest rates and now you're going to sell them at high interest rates, where does that money come from? Because remember, the Fed is not federal, so they can't get it from the government, and it has no reserves, right? There's no there to plug that hole. So I don't know. I find the whole thing kind of curious. Every once in a while, you'll find in that total number these odd things, like Belgium is buying a lot of bonds. Like Belgium doesn't have any money. Well, it ain't Belgium, right? It's some Saudi prince or something, running it through the ECB, or the UK. That's my other favorite, because that's really the Saudi money that goes through the UK, or African dictatorship money goes through London. So you got to actually look at that, because if Japan is net sellers and China's net sellers, those are the big dogs, and Russia is not really that important, but they're net sellers. The net buyers. And this is the other interesting thing about this, is if your plan is to just screw over your enemy, right, who borrowed a lot of money at low interest rates, you could do that. And that's what this guy was positing about China, is that we are trying to exacerbate the collapse of the Chinese real estate market to put pressure on China. It's an interesting theory. I mean, it is. But it's interesting. You look at Evergrande stock, for example. It's rebounded off the bottom, like really, really hard. I mean, should have gone to zero based on the data, but like Citigroup, same thing. Citigroup should have gone to zero, but it didn't.
New projections issued at the end of a two-day policy meeting on Wednesday showed 12 of 19 Fed officials expect one additional quarter-point rate increase this year. The Fed has two scheduled sessions left in 2023, concluding on November 1 and December 13. More notably, officials projected that while they still expect to begin reducing interest rates next year as inflation falls, the path down will be slower than previously anticipated. Though opinions are diffuse, policymakers at the median now see only a half percentage point of rate cuts in 2024 versus the full percentage point decline seen in their June quarterly outlook. Mark Yusko now dives into the issue of deflation, debt, bonds, and treasury holdings. Let's hear what he has to say.
The reason you have secular deflation is old people. And look, it is a fact that every single day for the next 13 years, something like that, 10,000 people will turn 65 in the United States, and another 10,000 will turn 65 in Europe. And Japan's already 11 years ahead of us. They're starting to age into the 85-year-old cohort. And you look at those places, and it is secularly a downtrend in inflation. And the only thing that's going on now, again, this is just the debate back and forth. Oh, but we have this 70s style inflation. No, we don't. We had a currency devaluation, the likes of which we've actually never seen. Right? Think about that. The United States had a currency devaluation we've just never seen. We printed half the money in the history of the Republic in 18 months. And now the chairman is like, shit, that was too much. I gotta claw some of that back. But here's the problem. And this is going to get into the little theory that I was talking about on China. Here's the problem. How exactly, Jerome, are you going to reduce your balance sheet? You are the buyer of last resort, the lender of last resort. So you bought up all these bonds. Who's going to buy them from you? China stopped. Russia stopped. Japan stopped. They're actually divesting. They're exacerbating your problem. So who exactly is going to buy bonds? Oh, we're going to freaking stuff them into the banks. That's gone. You did that. You put them in the banks, and then you went and jacked up rates, and you bankrupted a whole bunch of banks, like wiped them out. Why would you do that? You're supposed to be the banker in chief. Why would you bankrupt? Okay, that's a whole nother story. That's to set the stage for CBDC. You have to foment fear and distrust in the banking system. So the banks aren't going to buy them. So who exactly is going to buy them? Us. 65 to 85-year-olds. Well, I'm not 65 yet, but I will be. Old people buy bonds. They don't buy green bananas, and they buy bonds. And that's their only hope. And I've said for years, there's no law yet that forces you to buy bonds in your 401k. And, we've talked about this. I believe it should be against the law. Literally, there should be a law that prohibits anyone under 65 from owning a bond in their 401k. It's the dumbest investment decision you could ever make. But they could actually, and I think they might, and there's actually been bills thought of that would mandate that you buy government bonds in your 401ks. Be horrible. But wait a minute. If interest rates are 5.5 or 6, isn't that a good thing? Well, if inflation returns to its persistent decline at, sub 2%, 4% real, it's not bad. It's not bad. But I don't know who's going to buy the bonds from Jerome. I don't know who's going to do it. So good luck with that, Jay Powell.
Amid persistent concerns over the safety of its overseas assets, most of which are U.S. dollar denominated, China has slashed its holdings of United States Treasury bills for the fourth straight month. However, as the Federal Reserve and other major central banks approach the end of their rate hike upcycle that began in March 2022, analysts say Beijing's policymakers may need to reassess the situation and rethink their decision to dump treasuries. The world's second-largest economy offloaded $13.6 billion worth of U.S. debt in July, bringing China's holdings to $821.8 billion. According to the latest data from the U.S. Department of the Treasury, China's overall holding of U.S. debt remains at a 14-year low after reaching that level in June. Beijing has been continuously cutting China's U.S. debt holdings since early 2022, with two exceptions: in March of this year and July 2022, when it increased holdings by U.S. $20.3 billion and U.S. $320 million, respectively. Beijing remains the second-largest foreign holder of U.S. Treasury bills after being surpassed by Japan in June 2019. The reduction in U.S. Treasury bills holdings between March 2022 and this past July: China dumped $191.4 billion, Japan slashed $116.5 billion, Ireland cut $44.4 billion, Brazil shed $8.6 billion, and Singapore got rid of $4.8 billion, was partly because of the slew of aggressive U.S. interest rate hikes that have dampened bond prices. The Fed has cumulatively raised its benchmark rate by 525 basis points since March 2022 to the range of between 5.25 and 5.5%. In comparison, China's one-year deposit rate for deposits at leading state-owned banks such as the Industrial and Commercial Bank of China, and Agricultural Bank of China has been 1.55% since September. Also, Fitch Ratings stripped the U.S. of its triple-A credit status in August. The rating agency cited the deteriorating three-year outlook of the U.S. government's fiscal standing and the drawn-out debt ceiling negotiations between politicians. What do you think about these developments? Will other countries weaponize Treasury holdings? Let us know your thoughts in the comment section below. Also, make sure to hit the like button, subscribe, and turn on notifications. Thanks for watching.